This week's update is another one of those weeks where we've had a bit of everything. Mortgage rates, swap rates, lender behaviour, and some important economic data that helps explain what's really going on under the surface. So in today's video, we're going to cover mortgage rate movement and what lenders have been doing this week, swap rates and why they're still the key driver behind fixed mortgage pricing, lender behaviour, including a major new product from the Family Building Society, the latest ONS GDP data, which isn't exactly confidence boosting, the newest UK finance arrears and repossession figures, and finally, the Mortgage Works Landlord Barometer, which gives us a really good read on the buy-to-let market right now. And then at the end of the video, I'll pull it all together and explain what it actually means in the context of the mortgage market, who it affects the most, and who should genuinely be reviewing their options right now. And for those of you who are new here, welcome along. I'm Craig. I've been a UK mortgage broker for over 25 years, and every Friday I do a calm, no-nonsense breakdown of what's happening in the mortgage and property market without all the hype. So if mortgage rates, house prices, and the UK economy are your thing, give the channel a follow, hit the thumbs up, and let's get into it. So first up, mortgage rates. And honestly, this week has been a bit of a mixed bag. We've had lenders moving in both directions, some small increases here and then a few reductions over there. And it's been one of those weeks where it's hard to call it a clear downward trend across the board. But the big attention grabber was right at the end of the week when yesterday the Nationwide came in with some pretty noticeable rate drops. And that's the sort of move that tends to get the market talking again. Now, I'm not going to run through every single lender change in this video because it would take me all day. But if you want the detailed breakdown, I've been covering the full rate movements as they happen over on my Instagram channel. So make sure you go check that out. Next up, we've got swap rates, and they are slightly lower than they were at the same time last week, and you'll be able to see that on the chart on the screen. And this is one of those rare times in life where red on a chart is actually good news and green is bad. So as you can see, we're looking at good news right now, because when swap rates fall, it usually gives lenders room to reduce fixed rates. Now, it doesn't always happen immediately because lenders don't price mortgages day by day like a stock market. Over time, swap rates still remain the main driver behind why fixed rates rise and fall. So yes, swap rates easing is a positive signal, but it doesn't mean that the mortgage market is suddenly stable. It just means the direction of travel is slightly down. Now, lender behavior is where things get really interesting this week because we've had another noticeable product relaunch, and it ties into a theme we keep seeing again and again and again. Lenders are clearly trying to find ways to support buyers, particularly first-time buyers, without taking on reckless risk. And that brings us to this. The Family Building Society's enhanced family mortgage relaunch up to 100% loan to value. Right, this is an interesting one that's just been announced, and it's worth paying attention to if you're a first-time buyer or even a home mover who's been held back purely by deposit size. The Family Building Society has just relaunched its enhanced family mortgage, and the headline here is big. They're offering up to 100% loan to value. So yes, potentially no deposit required, but it's not a free money mortgage. It's basically designed for people who can afford the monthly payments, but don't have the deposit saved, and they've got family support available. Looking at the key criteria, no application or product fees, which is a good start. Minimum loan to value is 80%, but it can go all the way to 100%. Minimum loan size is 96,000 and the maximum is 750,000. And affordability can stretch up to 5.33 times your income, which is actually quite punching. Mortgage term can go to 40 years, and this is for purchase applications only, not for remortgages. Now here's the key bit. Even though it's 100% mortgage, the lender still wants the equivalent of a 20% buffer. But instead of it coming from your deposit, it comes from family support. So the borrower deposit is optional, not required, but the total support package must equal 20% of the property value. And the family can provide this support in two ways. Number one, they place savings into a family security savings account on which interest is earned. Or number two, they allow the lender to take a collateral charge over their property for the amount needed. Or they can use a combination of both if they wish to. So in plain English, here's an example. If you're buying a 400,000 property with no deposit, the lender wants £80,000 of security provided by family, either in savings, property security, or a mix. Now, what I actually like about this product is it's not the same as a gifted deposit because the family doesn't have to hand money over permanently. They're basically supporting the mortgage during the fixed rate period, and then at the end of that fixed rate, the security is released. Subject to conditions, obviously, like the mortgage being conducted properly and the borrower meeting criteria. And support can come from parents, grandparents, or other family members. So overall, this is a really clever solution for buyers who are stuck renting, paying £2,000 a month, but can't save fast enough because life's expensive. Now, that said, it is still a serious financial commitment for the family member providing the support. So it does need to be approached properly with advice, and everyone needs to understand what they're signing up to. But as a product, it's definitely one of the more practical family help mortgage options that we've seen. So if you're in this situation, it's worth looking at, because for the right person, this could genuinely help them get onto the property ladder years earlier than they probably thought they could. Now, what's interesting about this, though, is that it's yet another sign that lenders are trying to create solutions for the deposit problem. And I think we're going to see more of this across 2026. More innovation, more niche products, and more lenders trying to win first-time buyers. Let's move on to the economic data. And this week, the big headline is GDP, and it's not exactly reassuring. So looking at the latest GDP figures from the ONS, and honestly, they don't paint a particularly strong picture of the UK economy. On the surface, the UK economy technically grew in the final quarter of last year. Headline GDP came in at 0.1% in quarter four. Now, that might sound like progress, but it's weaker than the market expected because consensus was close to 0.2%. And it also mirrors the previous quarter because Q3 was also just 0.1%. So growth is there, but it's basically crawling along. But here's the number that a lot of commentators focus on because it tells you more about the economy and how it feels to the average person like you and me. GDP per head actually fell by 0.1% in quarter four. So while the economy is technically expanding, when you divide that output across the population, the average person is not better off. And that's why this data doesn't feel like a recovery, despite what the government will say. On an annual basis, GDP is estimated to be 1% higher than the same quarter a year ago, and across the whole of 2025, growth is estimated at 1.3 compared to 1.1 in 2024. So yes, we're moving forward, but not with any real momentum. And when you look under the bonnet, the sector split really tells a story. In Q4, production increased by 1.2%. Construction fell by 2.1%, and the services sector showed no growth at all. And that's important because the UK is a service-driven economy. Services are flat, very hard to build any sustained growth. But construction is the really big one here that I want to have a look at. A 2.1% fall in construction output is not what you want when the government's house building targets are meant to be taken seriously. And if we're brutally honest, it makes those targets look more like a political ambition than something that's actually achievable in the short term. Because targets are one thing, but delivery depends on confidence, funding, and viability. And right now, developers are cautious. Borrowing's expensive and projects just don't move forward unless the numbers stack up. Now, if we zoom in on December, the monthly figures were just as underwhelming. GDP grew by 0.1% in December, after 0.2% in November, although even the November number has been revised down, which is never a great sign. And December's breakdown shows the same sluggish picture. Services grew by 0.3%, production by 0.9%, and construction fell by 0.5%. So again, we've got an economy that's technically growing, but only just, and with key sectors still struggling. Now, what does this mean in the real world? Well, for most people, it confirms what they already feel. The economy is fragile, confidence is low, and it just doesn't feel like things are improving quickly. And from a mortgage market perspective, weak growth like this increases pressure for rates to gradually ease over time. But it does also suggest that we shouldn't expect anything dramatic overnight. So the takeaway is simple. Yes, the UK economy is still growing, but it's doing it at walking pace. And when you adjust for population, it's actually going backwards. And that is not a backdrop of a strong recovery. And that's why even though mortgage rates are slowly improving, the wider economic backdrop is still fragile. Next up, we're going to look at the UK finance arrears and repossession data. This is one of those topics where the headlines can sound terrifying, but the data is actually a little bit more balanced. So first, looking at homeowner mortgages. In Q4 2025, there were 80,490 mortgages in arrears by 2.5% or more of the outstanding balance. Now, importantly, that's actually 4% fewer than the previous quarter. So arrears are still there, but they're moving in the right direction. And within that total, 27,780 mortgages were in the lightest arrears band. So that's people who are behind by 2.5% to 5% of their mortgage balance. And again, that number is also down 4% quarter on quarter. Now, on the buy-to-let side, the story is similar. There were 9,520 buy-to-let mortgages in arrears of 2.5% or more, which is 9% fewer than the previous quarter. And again, the lightest arrears band, 3,480 cases, was down 7%. So overall, buy-to-let arrears have improved quite noticeably. Now, here's the key stat that matters most for context. Mortgages in arrears represent 0.92% of all homeowner mortgages and 0.5% of all buy-to-let mortgages. So even though the raw numbers sound big, as a percentage of the total market, arrears remain under 1% homeowners and around 0.5% for landlords. Now, that's not a market that's collapsing. It's a market that's under pressure, but definitely holding up. Now, we'll move on to possessions data because this is the bit most people worry about. In Q4 2025, 1,210 homeowner properties were taken into possession. That's 13% fewer than the previous quarter. And 770 buy-to-let properties were taken into possession, which is 14% fewer than the previous quarter. And UK Finance makes the point that possessions are still significantly below the long-term average, which is important. So yes, there are households struggling and we shouldn't downplay that. But the bigger picture here is that arrears and repossessions are not spiraling out of control. If anything, this suggests that the support measures, lender forbearance, and borrowers adjusting their budgets are all having an effect. So the takeaway from this report is fairly simple. We're not seeing a repossession crisis, we're seeing a pressured market, but one that is stabilising, and in some areas, improving. And for homeowners watching this thinking, is the mortgage market about to implode? Based on these numbers, I would say the answer is definitely a no. So yes, there is still pressure in the system, but we're not seeing the kind of breakdown some people predicted when rates started rising. Now, finally, let's talk about buy-to-let by looking at the Mortgage Works Landlord Barometer, because it gives a really good snapshot of what landlords are actually thinking right now. And honestly, the mood has clearly shifted. Compared with this time last year, landlord confidence in the short-term outlook for the private rented sector has weakened, and the numbers back that up. Confidence in their own lettings business has dropped from 37% down to 29%. Expectations for rental yields have fallen from 38% to 30%, and sentiment around capital gains has dropped again from 17% to 13%. So landlords aren't just feeling uncertain, they're increasingly pessimistic about future growth and future returns. Now, the market dynamics section is where it gets really interesting. Over the next 12 months, 46% of landlords plan to sell at least one property, and only 5% expect to expand their portfolios. That's a huge imbalance, and it basically confirms what we've been seeing for a while. Landlords are slowly de-risking, trimming portfolios, and deciding whether buy-to-let is still worth it under current tax rules, regulation, and mortgage pricing. Now, rent rises are still happening, but the pace is slowing. The proportion of landlords who have increased rents in the last year has fallen by 8%, down to 65%. So rents are still rising, but not quite as aggressively as before. Now, among landlords who do use borrowing, there's a clear trend developing. 52% plan to use buy-to-let finance for their next purchase, and 74% say that they'd be buying through a limited company structure, which makes sense because for many landlords now, limited company is the only way the tax position actually stacks up. There's also a big remortgage trend building. 39% of leveraged landlords say they plan to remortgage or do a product transfer in the next 12 months. So we could see a lot of buy-to-let refinancing through 2026. Now, in terms of portfolio profile, the average landlord in this research holds 6.6 properties, and they're generating on average rental yield of 6.4%. And 53% of landlords have at least one buy-to-let mortgage, and among those landlords, they hold an average of 5.6 loans. So overall, this isn't casual, accidental landlord territory. This is a sector dominated by portfolio landlords who are running it like a business. So the key takeaway from this report is fairly clear. Landlords are still in the game, but confidence is dropping. Selling intentions are rising and expansion plans are extremely low. And the long-term impact of that is simple. Less supply, more pressure on rents, and a rental market that stays tight for tenants. So buy-to-let isn't dead, but it's clearly changing shape and landlords are being far more selective. I'd love to hear from you landlords out there though. Does this data and what it suggests match your line of thinking and what you're actually seeing? So what's the big message across all of this? Well, for me, it's this. Act with caution. The direction of travel for rates is still slowly improving, but the economy remains fragile and lender pricing can at times still be volatile. And we're in that awkward phase where the mortgage market is improving, but it's improving in a way that could still change quickly, depending on inflation, global markets, and what the Bank of England decides to do next. So this isn't a rush out and buy immediately environment, but it's also not a sit back and ignore it environment either. Now, in terms of who should be paying closest attention right now, I still say first-time buyers are at the front of the queue, because what we're seeing is lender innovation happening again and again. We've just had another lender launching another product designed specifically to help people get on the property ladder. And that tells you something important. Lenders want first-time buyers business. They're actively competing for it, and they're starting to take calculated risks again, but in controlled ways. So if you're a first-time buyer and you've been waiting for the perfect time, you might not get it. Well, you are starting to get better options. And the longer rates gradually ease, the more affordability improves. So first-time buyers should be reviewing what's available now rather than assuming that they need to wait another year. And I'd also say there are two other groups who should genuinely be considering their options right now. Number one is those people that are coming off a fixed rate in the next 6 to 12 months. Because even though rates are improving, it's still a big jump for many households. Planning early gives you control. Number two is buy-to-let landlords, particularly those with mortgage borrowing. Because if almost half of all landlords are planning to sell at least one property, that tells you the market is at a turning point. So landlords should be looking at their refinancing costs, rental yield performance, tax position, and with a limited company ownership still makes sense going forward. Because the buy-to-let world is not getting any easier. So let's wrap all of this up for you. This week's data tells us a few key things. Mortgage rates are still moving around, but we're seeing more competition again, and nationwide cuts at the end of this week are a good example. Swap rates are slightly lower, which is helpful, but volatility still remains. Lenders are starting to innovate again, especially for first-time buyers, and that's the sign that confidence is still returning. But the economy is still fragile. GDP is barely growing. In fact, GDP per head is falling, and construction is shrinking, which doesn't exactly scream boom period. Arrears and repossessions aren't spiraling, which is reassuring, but the rental market is tightening, landlords are losing confidence, and many are planning to sell. So overall, we're in a market that's improving slowly, but still needs to be handled with care. It's not a crisis, but it's not a recovery either. It's a cautious transition phase. And for most buyers and homeowners, the best approach right now is to stay informed, plan ahead, and make decisions based upon your own situation, not just the headlines. As always, if you've got a question about your own mortgage situation, drop it in the comments below and I'll do my best to answer. And if you found this useful, please give the video a thumbs up. And if you're not already, please do subscribe. In the meantime, have a great week and I'll see you next Friday.